Everyone. We'll get started here in just a minute. Welcome to Daily Mortgage Rates Live with the Mortgage Calculator. Today we're going to be going over fix and flip loans as our detailed topic with Jose Gonzalez. And in a few minutes here, we will get started and go over the live rates for today. It is July 17th, just after 11 a.m. So most of our standard programs are live. Just give us a few minutes to get the live stream up on all the platforms, and then we'll check out the rates. All right, good morning, Cressida. If you have any comments, you can drop them in the chat here while we're waiting to get started. Good morning, Jason. Everybody's tuning in. Thank you. So it looks like we're live on YouTube. And there we go. Looks like we just went live on a few other platforms. So we should be good to go. Let me go ahead and get started. All right, welcome everyone. My name is Nick Hershey. I'm the president of the Mortgage Calculator. I am joined here by Jose Gonzalez, our sales manager with 27 years of experience. Today, we're going to go over our live rates as we do every morning. We'll go ahead and check out our pricing tool where we can check out the general rates and terms for today. If you'd like a full breakdown of a loan estimate, please get with our licensed loan officers. We have over 300 licensed loan officers. And we can do primary homes in 24 states and our business purpose fix and flip loans that Jose is going to present here in 44 states roughly. So a lot of great options for our investors out there. But without further ado, now that we are live, let me go ahead and pull up the standard rates today. So let me switch my screen and we will get started. So this is our pricing tool. As I mentioned, for our mortgage professionals, this will show us the general rates and the APR, including all the fees for today, July 17th, just after 11 a.m. So the standard programs are live with some new rates here. If you'd like a full breakdown and a full loan estimate with all the fees that go into the APR, please get with one of our loan officers. So for our live rates demo, as we do every morning, we'll set up the same scenario so we can compare across all the different programs. We'll set up a 400,000 loan amount. We'll set the LTV to 80% loan, 20% down payment. We'll set the desired price to 99 for all our demos. That means we're going to ask the computer to find the best rate at one discount point in cost, which is the typical request. And we're going to compare our conforming conventional rates. Then we'll check out our FHA programs. And then we'll go into our expanded guidelines, also known as non-QM, where we have over 5,000 additional loan programs using alternative income. And that's really where we specialize at the Mortgage Calculator. We also offer VA and USDA. Remember, VA is only for our eligible active service members and veterans. If you do happen to be eligible, let us know. We'd be happy to quote it, no problem. And same with USDA. That's only for properties that are eligible in a USDA eligible area. If you happen to be shopping for one of those, let us know and we'll quote it up for you. So for the first example, as we do every morning, we'll do a conforming purchase, 30-year fixed standard loan, primary occupancy, single family home, one unit, state of Florida, Miami-Dade County. And for all the demos, we use an estimated FICO of 760 and an estimated debt to income ratio of 40. So with these settings, let's check out the conventional rates this morning. A little bit up, hopefully it goes back down a little bit this week. 6.99 for one discount point in cost. Final APR of 7.157. So that's just a touch above where it was when we left off on Friday. So hopefully we see some more downward movement this week. Should be good for us. Now, if our customer, for any reason, doesn't qualify for a conventional, the next option we always look at is set up the same scenario here, an FHA program. Remember, FHA allows a little more leniency on credit type of events, as well as a much higher debt to income ratio. However, for the example, we'll still keep the debt to income ratio and everything else exactly the same, so we can compare apples to apples across the programs. So FHA this morning looks like the best option we have here, 6.25 rate for 1 discount point in cost, puts our final APR at 6.842. So with this program, if our customer qualifies for conventional or FHA, actually FHA is a touch cheaper. So definitely recommend our customers that are qualified for both do check out FHA. It actually has some savings here, even though that does include the upfront mortgage insurance and yearly mortgage insurance. So a little bit higher APR compared to the rate, but it's still a touch lower than conventional. So a good thing for our borrowers that need FHA and for our borrowers that qualify for both. Now, if our borrowers can't qualify for either, that's really where many other banks or lenders don't have other options, but that's really where we specialize here at the Mortgage Calculator with our expanded guidelines, also known as non-QM product offerings here. So everything else will stay exactly the same, but now we have a new option pop up, our income verification option. So for a non-QM program, we typically would not choose full doc. That's what we use for conventional and FHA. That's 2 years of tax returns. So we'll typically choose one of these alternative options, such as asset-related programs, business bank statement programs, DSCR programs for our investment properties, personal bank statement programs. That's our most popular one by far. So that's one we'll use for our demo. We also have RSU, stated, VOE, 1099, P&L, and no income CDFI. So for the demo today, as we do every day, we'll do our personal bank statement, 12-month, most popular program by far for our self-employed borrowers. Many times our self-employed borrowers with 2 years of tax returns have various write-offs and may not qualify at all or may not qualify for the income they really need. So in this case, instead of their tax returns, we're simply going to use their last 12 bank statements to determine a debt-to-income ratio of 40% in this example, using just their cash in the bank, no tax returns involved. So most self-employed borrowers qualify for double, triple, quadruple the income using this method and therefore can get the home they really want. So these non-QM solutions are amazing, especially for our borrowers that need a little extra help. Best option here for the bank statement, 7.625 rate, 0.875 discount points and costs, and a final APR of 7.688. So remember the conventional was at 7.1 something, I believe, just a minute ago. Here for about 0.5 higher, we can use bank statements, which is amazing. And our customer may not even qualify for conventional, so this may be the only option using those bank statements. But even for customers that qualify for both, a lot of customers that are self-employed may end up having to use this option for various reasons. So some great options here for our borrowers. If we cruise down this list, you'll see we have dozens and dozens of bank statement options. Some of these at the higher rates may allow things like bankruptcies and foreclosures and other credit events that would put us out of compliance with the standard conventional and FHA programs. So we can get around other guidelines as well with the non-QM programs. So that's really why we love these options. Now, before we get into Jose's fix and flip example, we always want to check out some standard investment property examples. So we'll set this up to 80 LTV, 20% down payment as we did before, and we're going to change to investment property here. Now, for investment properties, we only have a couple options. We have conforming options, conventional options, and expanded guidelines, aka non-QM. Remember, all the government options are not for investment properties. FHA, VA, USDA are not applicable. So we'll start with conforming conventional. Everything else will stay the same. Notice we only edited the occupancy here to investment. So let's see what adjustments the conventional programs have added when we do an investment property. So the best option here, 7.125 rate, but pretty hefty discount points, 4 discount points and cost. Puts our final APR at 7.392. So still a great option for our borrowers that qualify for conventional, but most of our investors that are looking to invest would rather save these for discount points. This is $16,000 in our little quote example here. So that's a lot of money that our investors would rather deploy elsewhere many times. So most investors ask us for a higher rate quote in order to reduce those discount points. And unfortunately, with conventional, we do not have any other options at the moment, just because of the way conventional is set up. And that's where we love to present our non-QM options. So for the final demo today, investment, 80 LTV, and we'll set this to expanded guidelines, aka non-QM. And now we have to choose our income, the most popular option by far, and the most popular loan we do at the Mortgage Calculator by far is our DSCR loan option. And that's because it doesn't actually require any income or employment from our borrower. we simply use the estimated rental income from the property. So if the estimated rental income covers the PITIA, the mortgage expenses for the property we're proposing, that's a DSCR or debt service coverage ratio of 1.00 or higher, aka the property cash flows on a monthly basis. We also have options for a DSCR ratio under 1.00, aka the property doesn't quite cash flow on a monthly basis. So a ton of different options. For our demo, I always put 1.5. That way we can see all the different pricing pop up. And finally, we have to select a prepayment penalty. That is standard for a non-QM investment property. We always select 3 years for our demo. There are 0 options, but that will limit the amount of loan programs that we can see and obviously cost more. And there are 5-year options as well, which will again limit the amount of loan programs, but it does save us money when those options are out there. So we always choose 3 years for our demo so we can show the most common options. So for DSCR here, we have a 7.875 rate for 0.85 discount points and costs. Solve that problem for our customer. And the final APR of 7.937. So remember, the conventional was around 7.4, 7.5. Here we have a DSCR option for 7.9. A couple of these other ones for 8.1. So some great options for a little bit higher APR. Many of our investors, I'd say probably 90 to 95%, when they're presented with a conventional versus a DSCR, we'll go with a DSCR quote for all of the flexibility, no income, no employment required. You can do 1, 2, 5, 10, 20 loans at a time because there's no income or employment involved. So you can properties, purchase multiple properties, tons of flexibility here that is afforded with these programs. And of course, we solved the discount points. We went from $14,000 in cost to $3,400. So our investor can get this as long as the property cash flows and then use that $14,000 to another investment. Now, if you cruise down here, you'll see we have dozens of options. Some of them have different prepayment penalties. Some of these may allow short-term rental incomes. Some may allow bankruptcies and foreclosures. Please get with our team. They can find the one that fits best for you under these non-QM programs. And now, let me go ahead and switch my screen. And we'll introduce Jose's topic for today. For those of you that joined us earlier, we're going to be talking about fix and flip loans. So nothing that we went over before, right? The live rates are never applicable for fix and flip. Fix and flip goes by the project, right? This is another very important thing. I'm sure Jose is going to mention this, that you can't just quote a fix and flip in general. Has to be a very specific project with a specific purchase price, a specific budget, and your specific experience level as an investor always goes into the quote. So since none of that is on our live quoting system that we just went over, obviously we can't quote the fix and flip rates live, but we can with a little bit of elbow grease. So Jose, while we were going through there, he was putting in some work there to set up a real fake example, I guess, but real numbers for a fake example. And that way we can have a real fix and flip quote. So Jose, you might want to introduce it a little bit and then we'll go ahead and check it out.
All right. Yes. Thank you for making that very important note that we try to do the best we can here in the live show to illustrate the fixed flip loan. But every loan is an individual loan due to the specifics. Because, as you mentioned, definitely experience level is a factor. The more experience you have, the higher the loan to value, the higher the loan to cost, and obviously also the better the rate you're going to receive. It is also important to know that it's going to depend on the as is value of the property and the ARV, or the after repaired value for the property, because very important to note that fixed flip loans do not take the borrower's personal income into consideration. A fixed flip loan where the borrower is closing in an entity is considered a business purpose loan. Business purpose loans never use borrower's personal income. What it does do is it vets the profit in the deal, which is going to be also another big factor in determining the viability of the deal and the interest rate, loan to cost, and loan to value as well that will be offered. If the profit is too low, the loan will not be granted. or it may be granted, but at a much lower loan to cost and loan to value than the investor would hope for, and also at a higher interest rate. So, with that being said, I will show you here my examples. I have two purchase examples and two refinance examples. Now, on the refinance, I will also state that the examples I have here are for free and clear properties that the investor purchased it cash and now they need money for the rehab. So, they're going to cash out the property to try to recoup some of the money they invested in, and also to get their rehab covered. If you did have a loan on that property, then that would just be that much less money that the investor would receive at closing, because the initial draw would probably go mostly to cover the debt and possibly a little bit of their rehab. So, in my first example here, it is a best case scenario of an investor with 10 plus flips. I mean, this person flips houses left and right. Um, what they
And 10
usually,
plus is in the last 3 years, I assume, is
yes,
what you're assuming? Okay,
that's what I was about to state, is that they do ask us for the number of flips in the last 3 years. And very important to note, this is super important to note, that the investor has to be directly involved as an owner of the flip. They cannot be a JV on the flip where they just gave some money. They weren't anywhere in the title, they weren't included in the LLC. That's not going to work, because that's not going to be considered experience for that investor. They have to have been involved in the complete process of the flip, from the purchase to the rehab to the disposition of the flip, whether it was sold or whether it was refinanced into an end loan and they kept it as a rental property. It is very important to have to show a successful track record, because remember, um, personal income is not taken into consideration. Obviously, credit is, but personal income is not taken into consideration here. So it's very important to be able to show that track records. I mean, that's one of the documents that they have us provide, the Excel spreadsheet with the track record of the investor. And also, in that same note, we sometimes have contractors that want to do a fixed flip loan, and they are under the misconception that the homes that they have built for other people that were involved in a fixed flip are considered a track, part of their track record, and it is not. I mean, in some cases, you may be able to get an exception where the fixed flip lender may be able to grant something like that, but I will tell you, do not use that as your method of operation. What you should consider is that that is not going to be allowed to be considered as part of their successful fixed flip track record, because they were not an owner of the flip. They just built the home or did the rehab for the investor. So keep in mind, they have to be owners. So in this example here, we have $150,000 purchase, and it's $150,000 as is value. That's very important.
can you touch on real quick why those are blank? Those were just because you pulled those from the pricing
Yes,
tool, correct?
yes, correct. That was just because I copied and pasted the complete term sheet, and that is just an empty field there. But the obviously the amount requested should match the loan amount. So in this case, we do have 85% loan to value of the purchase, right? Which is pretty good. They got $127,500 loan as the initial advance at closing, which means for that $150,000 purchase, the borrower had to come up with 15% down payment for the closing, and then $75,000 is our rehab budget. So In this scenario, we are allowed a maximum loan amount of $202,500, right? Which is, so they are
So they're doing
financing
100%.
100% of the rehab. So that's pretty cool. 85% of the initial purchase amount for the as is, and 100%, I repeat, 100% of the rehab. Now, important to note here that this project has ROI projected of 30.72%, which is what the lender is going to be looking at with the magnifying glass. And we have an ARV of $300,000. That's the key here, because our total loan amount, 202,500, to 300, that's what they're looking at. So it's a really sweet deal. That's why they're giving 85% of the initial purchase at closing, as they call the initial advance, and then the 75% of the rehab budget that's being financed by 100% of it is going to be on a draw basis, like most other construction loans. And to get to our interest rate is 10.24%. So again, here you see ARV 300 adds a little bit of extra. These are our costs here. I mean, not obviously there's some costs aren't included there, some of the extra title fees and stuff, but that's pretty complete with an estimated gross profit of $73,505. So again, 10.24% for our experienced investor, right? And I want you to look back at this number here again, because I'm about to show you our inexperienced investor, right? 127,500 at closing, right? And 2025 max loan amount. So now you see here our inexperienced investor. Now this person does have, great credit score, 800, but they only have one plus flip in the last 3 years. Usually the tier is from 1 to 3, right? So whether it's 1 or 2 or 3, it's going to be the same number. So you will note same $150,000 purchase price, same $75,000 rehab budget, but the difference now here is our maximum loan amount is 191,250. So they are considering 100% of the rehab because they still consider it. There's a lot of meat on those bones, but due to the inexperience level of the flipper, they want the flipper to have a little bit more skin in the game. So they reduce the initial advance to 116,250. So you see now, instead of being 85%, it's 77.5% on the initial advance, but 100% of the flip. And if we go down here, they're looking at the same profit. Obviously, it's the same deal, $300,000 ARV. But when we go down here to our rate, again, a little bit higher also. So a little bit lower on the amount that they're giving by, I think it was 7.5% less LTV. And the rate also goes up about 0.75%, 10.99. Now remember, these are interest only rates as well. No principal due here, no prepayment penalty ever on a fixed flip loan either. So now we have our cash out example. Now again here, this is for our flipper. Now this could be where they have a debt or they don't have a debt on the property. It's going to be the same mathematics because they're going to be looking at the ARV, the present value, the rehab budget. So here we have the same $150,000 as is value, $75,000 budget, and $300,000 ARV. So our they are going to allow for 100% of the rehab, but note that only 60% of the as is value. So the initial Advance at closing would be $90,000. So keep in mind how that comes into play if your borrower has a debt on that property, right? If they purchased it with hard money, this is what they're going to get as the initial advance, and then they'd have to come up with whatever other funds at closing. Right? So, uh, same example here. Now, let me show you the rate. So notice though, $165,000 is the total loan amount, even though our ARV, I
So
mean our
break this
as
down a
is,
little bit, Jose. So this person paid how much for the property?
we're assuming in this case that they paid $150,000. That
So
the
their bank
as is
account,
value,
so their bank account 150. They paid cash. They went to zero. Now
right?
they're asking for a cash out refi. How
Right.
much money is going back into their bank account?
At the initial advance was $90,000.
But
So
since it's a cash out refi, it's all at once technically.
yeah, yeah,
So
yeah. Well,
it's the
90.
full plus the first advance or whatever it
Yeah,
is, right?
yeah.
But what's the full loan amount then?
165.
So their bank account went from 150 to zero to buy it. Now
Right.
it's back up to
Excuse me.
165 roughly.
Roughly.
But
Right.
of course, as Jose said, they only get the initial and then advances based on the
Right.
work, right?
So in
So,
that,
but by the end, their bank account will be back up to 165. But of course, they'll have paid for work, so back down to whatever.
so so the difference here is okay. There's an extra 15 grand there from what they paid to the loan amount of $165,000. So essentially, they will have purchased this property and put $60,000 to to fix it, and that's it. 60 grand will be their total outlay
Outlay at the end.
at the end.
Once all the
Yeah,
refi is done. Okay, yeah, it's really a little confusing there, but it's a big win at the end of the day. This is an even bigger win typically than buying with the flip funds. A lot of times we can get a little extra juice out of this squeeze here, but
absolutely. And when you consider that the pot of gold at the end of the rainbow is the $300,000 ARV, that's what they're looking to get to. They're going from 150 to 300, right? With a little bit of action in between there. So there's a nice estimated gross profit there. Again, it's the same deal, $73,505. That's a good chunk of change there. The lender knows it. That's why they're willing to do this deal. And 10.74 is the rate for our experienced flipper. And now our inexperienced flipper, same scenario here. There's no real difference here because in this case they only allow this cash out scenario when you have three or more flips. The person with one or two is shut out of this scenario because it's too high of a risk for the lender to lend them money because they don't have enough of a track record. So the flipper that would need to do this type of a situation would probably have to look for a partner that had the experience and then share the profit to be able to get the deal because they will consider the partner with the higher experience level only. They're not going to go with the worst case of the two, and only one of the people in the LLC has to be on the loan. So obviously, it would be the partner with the higher experience level. So you're looking here, similar scenario with the maximum loan amount of $165,000. But what is going to change is the rate, not by much either, by increases by about a quarter percent to 10.99 from 10.74%, which was the experienced person. So again, the key to this whole situation is the profit in the deal, which is going to be driven by the ARV as is value and the rehab budget. I mean, you could have the perfect borrower in every sense of the word, but if there's not enough meat on the bones, the deal is not going to get approved.
Thank you, sir. We got one question here. Good question from Levine. How many fix and flip is considered unexperienced investors?
I would say more than three. Because 1 to 3 is usually the initial tier, and in some cases, like you noticed in the rehab and the refi part, 1 or 2 isn't going to cut it. You'd have to have at least three. So it really depends on the transaction. But I would say if it's a purchase, four or more, and if it's a refi, three or more.
Stuff. Looks like that's the only question we have at the moment. I know these deals are complicated, guys, but once you start structuring them, it'll make more sense. I promise. So just get the info. You do have to get all the info, as Jose said. You have to know everything, right? How much they purchased it for, how much they're rehabbing it for exactly, what the actual as after repair value, the ARV is. All of those things we have to do a quote. So it's very hard to just quote a general rate and term like we did in the first part of the show for a fix and flip or any type of construction project, really. So please gather that info from your borrowers, pop it in there, check out the options. We do have a few fix and flip outlets. Some follow the stuff that Jose was talking about. Some allow less experience but are much higher rates and terms and lower LTVs and whatnot. So just because Jose's examples were for 1+ experience, we do have no experience options. We do have other options that have different tiers that we mentioned. So a lot of variation that goes in with these programs. All right, good thing I talked a minute. We got one more question, Jose.
But let me
Okay.
add one very important point as well before we get into the question is exit strategy.
Mm.
Right. Very important that you also discuss with your investor the exit strategy, right? Okay, if it's gonna be a fix and flip where they're actually reselling the property, well, that's where the ARV comes into play. But if it's going to be a fix and hold, which is it's going to be the same fix flip loan, the different, because that's just what they call the loan. But in this case, they're going to hold the property as a long term or a short term, whatever. They're going to keep it as a rental property after
Which
the
is more
appraisal
popular
completes.
these days too, right? The fix and flip for sale, not as much meat on the bone these days, right? So a lot of people are
Right.
fix and hold. I'd say about 90% of our requests are fix and holds, right?
Absolutely, because rents are just, as we all know, skyrocketing. Everybody's just loving it. That's why the DSCR loans are so popular, which is the perfect exit strategy here. And it's going to be basically for the MLOs a 2 for 1 because you're going to do the fixed flip loan, and then that's going to transition over to the end loan, the exit loan, which is going to be usually a DSCR loan. So it's really important that all of those factors are considered to see if that's what's actually going to happen. Because when you are presenting the loan to the conduit that's going to fund it, that's one of the big things that they would want to know, and that you're going to have to put forth.
Excellent. Here's a question kind of has to do with everything. Since ARV can be determined by a CMA in a market where values are dropping, would an appraisal be more appropriate to establish? We have to use an appraisal, actually, guys. Jose, you want to talk about the type of appraisal?
Yes, absolutely. Now, for these deals, they're always going to require an appraisal. Now, maybe Melvin there is asking about doing an appraisal up front for the borrower's sake prior to submitting. I don't know, but it has to be an ARV appraisal, which is going to take into consideration the as is value of the property, the upgrades that are being done to the property. All of this has to be documented. Paperwork has to be provided to the appraiser, and then they're going to look at the ARV, which is the after repaired value to the property, and that's going to have to be supported by comparable sales in that market. Right, so they're going to look for properties recently remodeled in good condition as far as an appraisal, and that's what they're going to use. They're not just going to make up a value based on how much money you put into it. So it does have to be supported. The ARV does have to be supported by actual sold comps in that market. So Very, very important. Yeah, you're going to reach out to your real estate partner here, obviously, to have them give you a good market analysis. If someone wants to do an appraisal up front, that's okay, but it may not be usable unless the appraisal is ordered in the manner that it needs to be ordered in order to be submitted for the loan. It has to be ordered by the lender, by whoever's originating the loan, by the loan originating company.
One thing to note too, all of the fix and flip will typically require a secondary valuation as well, which is a CDA or some sort of other verification of the ARV value. And a lot of times that secondary valuation is very, very tight, very tight. All of the parameters they use for those secondaries uh, will sometimes knock your value down just because of very conservative formulas they use there. So the start not as important as how we end, right? Because the investor or lender is going to do regular appraisal and usually a second. They both have to match up. Whichever is the lesser will be your ARV that we use. All right, we got one more question, Jose. Are conversions as popular? I don't know which. Talking about a condo conversion or something, or
Yeah, I'm not really sure. Can whoever asked that question, can you please expand on what you mean by conversion? Because that's the only thing I could think of is condo conversion, but that would be like a whole project, not one unit.
yeah, and that would be more like a ground up type of project almost, right? It's a huge, huge, more of a development more so than a fix and flip single family, which is kind of what we're talking about today. Everything we did today was single family, correct, Jose?
So they're saying change property use, maybe what, like from a one unit to a two unit, stuff like that. I mean, that now we're talking zoning variances and a bunch of other stuff, but that is something that can be done with a fixed flip loan, where they do ask when we are structuring the term sheet, they do ask for if that kind of situation is happening. But keep in mind now that is going to be a more involved process, and make sure that you plan accordingly for the time that would be needed and that the upfront work has been done, because you're not going to get a fixed flip loan where you still have to get zoning variances for usage changes, because that just takes too long.
Has to be either by right or already approved, basically,
Yep.
right, Jose?
Yes.
So zoning changes are by right, where you can do them, no questions asked. That will be approved. Or if you've already done some letters and got some sort of documentation from the city or county or whatever it is that says it will be allowed, then you could proceed. But if it has to take a zoning meeting, that's not going to be a fix and flip loan, right? You're going to have to do that zoning meeting, get approval, then apply for your fix and flip loan once you have approval for that. So very difficult. Good questions, though. Good questions for sure. And just remember too, if you're adding units, the ARV is going to be based on 2 units, not one, right? So you don't want to go in the wrong direction. Also, it still needs to be. You want to talk about highest and best, Jose? That's really where they can get stuck here.
Well, yeah, that's a very tricky situation, because the appraiser is going to have to comment on the appraisal that if the current use or the proposed use is the highest and best use for the property. So if you have a property that is like the only property type in the area for miles, you may have an issue finding comparables, and you may have an issue where the proposed use is not the highest and best use for the property. And if that does happen, that loan is not going to be possible.
So you can't take like a luxury home in a luxury home development just because that zoning in that area says you can do a 2 unit. You're not going to be able to do a 2 unit, right? Because every home in the whole luxury development is giant 1 unit luxury homes. There is no duplexes there. So just because it's by right, you're not going to get approved because the appraisal won't match it, because the appraisal will say the highest and best is single family, and you can't get a loan approved when the highest and best is a single family to create a duplex, right? So that's where you can get stuck, or the vice versa, right? You can't take a quadplex and keep it a quadplex if everything around it has already been turned into luxury homes. Now you need to take your quadplex and turn it into a luxury home so it matches everything around it. So highest and best means you have to match. But that's a great question there. If that's why the property hasn't sold is because it's out of compliance or out of match with everything in the neighborhood, that's a perfect opportunity for a flipper to go in there, take the risk, and convert that to the proper amount of units that matches the area and turn it to the highest and best. So these are great opportunities to turn things to highest and best, but just don't get caught with thinking something's highest and best when it's not, right? So that's where you can really get in trouble. So no more questions. I think we're good to go. Anything else you want to touch on, Jose, on that?
Nope, I think we covered it all.
All right. Long one today. Thank you guys for tuning in. Thank you for staying with us. Fix and flips are complicated. Please reach out if you need any help. Our team is experts on these, and we have quite a few outlets, not just for what Jose presented. There are some outlets for no experience. Don't get afraid there. Those are just the more preferred outlets that Jose went over. So please reach out if you got a project. We'd be happy to structure it. And you will catch us tomorrow at 11 a.m. for another episodes of Daily Rates Live. Thanks, everybody.